Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Aditya Birla Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ajay Srinivasan, Chief Executive, Aditya Birla Capital. Thank you, and over to you, sir.
Thank you, and good afternoon, everyone. It gives me great pleasure to present the business performance and the financial results for the quarter and the year ended March 31st, 2022. Let me start with slide 3. I'm hoping you have the decks with you because I'm going to be referring to slide numbers. So let me start with slide 3, which provides a snapshot of the key highlights for the quarter. With a profit after tax of 450 crores in the fourth quarter, we ended the year with a PAT of 1,706 crores. The quarterly profits and the annual profits are both record highs for ABC. Our profit over the last 5 years has grown at a compound annual growth rate of almost 25% per annum and has catapulted us into the top 100 listed companies in India in terms of profitability. As you will note from a subsequent slide, we are on track to deliver the targets we had announced for each business in FY24. In some cases a year ahead of target and in some cases 2 years ahead. Building a material retail franchise has been one of our focus areas, and through an expansion in our own branch network, which are now over 1,000, and our 150 plus ecosystem partners, we have grown our customer base exponentially. Today we have a significant retail franchise with over 35 million active customers, a growth of 36% year on year. Slide 4 provides the progress made across our platform in terms of growth, in terms of margins, and in terms of profitability. Our NBFC's focus on the retail and SME segments has led to that book growing by 25% year on year and making that segment 62% of our book, an all-time high. That has led to Q4 margins expanding to an all-time high of 6.37% and an ROA of 2.4% for the quarter. The focus of our housing business on the affordable segment has led to very similar results, namely high growth in that segment, all-time high margins, and an ROA of 1.9%. In our asset management business, we've seen our focus on retail and equity lead to the equity mix growing to the highest level it's been at of 41%, and our profits for the year being an all-time high with an ROA of almost 35%. In our life insurance business, we have seen strong growth in new business and in renewals, and we have delivered a net VNB margin of 15%, which is an all-time high and well ahead of the guidance given earlier. In our health insurance business, our growth and differentiated model has led to us breaking even in Q4, excluding, of course, COVID claims, thus making us the fastest standalone health insurance company to break even. Moving on to slide 5, the top left of the chart will show that we have almost doubled our profits over FY20 and have grown 51% year on year. This has been possible by a very strong performance across all our businesses, as you will see on the right-hand side of this slide, with the lending businesses in particular leading the way with a 44% increase in profitability year on year. With a platform profit before tax of 2,666 crores, we are a significantly profitable player operating in the financial services industry. Slide 6 speaks to the diversification benefits that ABC enjoys versus some of its monoline peers. If I can draw your attention to the bottom half of the slide, you would note there that our PAT growth at 18% per annum over the last 3 years is actually significantly ahead of the average of a group of our peers consisting of 10 large NBFCs, 5 large private banks, 5 large HFCs, 3 listed AMCs, and 5 large life insurers who delivered an average PAT CAGR of 2% over the same period. In fact, the benefit of our diversified model shows up in the fact that our profit growth is much greater than the median profit growth of any individual sector, which you will notice on the extreme right of the bottom table on this slide. In effect, therefore, ABC has become the fastest growing company in terms of profitability amongst the top 16 listed non-bank companies in India over the last 3 years. Slide 7 shows the progress made by businesses on each of the key metrics we had set out for ourselves for FY24. I will not go into each line, but I will say that other than on our protection mix in the life business, which is lagging a bit due to industry issues, COVID, and other such issues, and which Kamlesh will cover in his section, we are well ahead of plan on each and every metric and in some cases have already hit our FY24 target in FY22. Slide 8 shows the track record we have built in terms of building scale, a leading retail franchise, and profitability. Our total gross premium of 13,867 crores makes us an insurer of scale operating in the country, and the journey from negative VNB to a positive VNB by tripling our net VNB over the last 2 years in our life insurance business, or the break-even of our health business in record time, shows our strong focus on value creation. On the asset management side, our equity mix has jumped by 17%, while our overall AUM has grown strongly, and we are today among the leading fund managers in the country in terms of scale. Again, the journey from 19 basis points of PBT to 31 basis points this year has been a result of our strong focus on profitable growth. In the lending businesses with a book of 67,000 crores, we are bigger than some mid-sized banks operating in our country. The journey of our retailization and focus on profits is very visible here too, and will be covered by Rakesh in some detail in his section. And finally, when you look at our other businesses, we have turned a loss of 10 crores in FY17 into a profit of 190 crores through our focus on portfolio optimization. Slide 9 sets out the many advantages of the ABC platform, but let me illustrate the value of the ABC platform through just a couple of examples. I'd like to draw your attention to slide 10, which illustrates two important facts. First, the technologies that we have deployed to drive better outcomes, and the fact that unlike many others, we have been able to leverage synergies and rapidly deploy these technologies across our platform. You will note from the x-axis on the chart that several of these technologies are implemented across 4, 5, 6, and sometimes 7 of our businesses, thus really achieving economies of scale and the benefits of synergy that we can arrive at such a platform. I cannot stress enough the value of this to our platform. Slide 11 shows some other assets of ours that bring to life the synergy benefits of ABC. Our mobile app, for instance, allows our customers to access 250 services across ABC's businesses seamlessly. Our data analytics allows us to offer pre-approved product offers across ABC to our direct customers when they view their ABC dashboards. And our One ABC branch format is allowing each of our businesses to expand their branch presence across the country in a highly cost-effective manner while providing them revenue synergies as well. Let me end with slide 16, which shows our key financials from FY17 to FY22. With a 5-year PAT CAGR of about 25% per annum, we've effectively nearly doubled our profits over the last 2 years and tripled our profits over the last 5. Given how challenging the environment has been over this period, this is really a testimony to our unique business model and the absolutely incredible efforts of our teams. With that, I will now pass you over to Rakesh to walk you through the lending businesses.
Thanks, Ajay, and good afternoon, everyone. I will now walk you through the performance of our lending businesses, starting with NBFC and then housing. In the NBFC business, we had a very strong Q4 with our loan book growing 11% quarter on quarter, NIMs hitting all-time high of 6.4%, and ROA at 2.4% for the quarter. As we have mentioned before, our focus in the NBFC business is on growing the higher margin retail and SME segments. As the environment started to normalize, we focused on expanding our business, and as a result of which NBFC disbursements for Q4 increased by a solid 49% over last quarter and 51% over Q4 last year. 65% of these disbursements have been to retail and SME segments in line with our stated strategy. As a result of this, our SME plus retail book has grown by 15% quarter on quarter and 25% year on year, and now accounts for 62% of our total book, the highest it has ever been. Our focus on growing retail has resulted in our active customer count growing to 3.6 million. We have also started cross-selling to customers acquired through the digital ecosystem, which will help us monetize this acquisition engine and result in better returns. Our focus on driving value by optimizing the product mix has led to continued upward momentum in our financial metrics. For the full year FY22, our margins expanded by 91 basis points over last year. Cost-income ratio reduced by 106 basis points and credit costs reduced by 12 basis points. Margin expansion further supported with a continued focus on reducing cost-income ratio and improving asset quality has led to NBFC delivering a full-year PAT growth of 44% over last year, taking our ROA to 2.3% for the full year compared to 1.7% last year. I would like to especially call out the focus we have put in collections, resulting in a much better quality of book. Our gross stage 3 book reduced to 3.1% from 3.9% last quarter. We resolved 130 crores of stage 3 assets in quarter 4 and are on track to resolve another 220 crores by H1 of this year. Our collection efficiency has further improved to 99.6%, better than last quarter as well as pre-COVID levels. And we are confident we will be able to sustain this quality of book going forward. This, coupled with our stage 2 portfolio going down to 5.4% from 7.5% and reduction in 60 plus DPD book to 1.1% versus 1.5% in the previous quarter, we are looking at a much better financial performance for the next quarter and the financial year. With a healthy capital adequacy ratio, we plan to grow our loan book by at least 20% in FY23. The financial numbers bear out the fact that the strategy we are following is delivering the desired results. And as we continue down this path, we will see better returns. Let me now spend some time setting out what has driven growth in retail and SME segments and give you some sense of where we are headed. Like I had described to you in previous quarter, our focus is on 4 pillars. Product suite expansion with a strong customer focus. Enhanced distribution capacity. Third, cutting-edge technology by creating consumer and MSME lending platforms. And fourth, strong risk management, catering to multiple product segments and delivering stable risk-adjusted returns. Let me share the progress we have made in these areas, starting with the retail segment. The contribution from new products grew nearly 3x in the last 2 years. This includes small ticket loans for the emerging income segments and customized ecosystem products like buy now, pay later, checkout financing, education loans, merchant loans, etc. We plan to grow this portfolio by more than 2x in this year. We have also increased our sourcing from direct and digital ecosystem channels to 49% as compared to 19% 2 years ago, and plan to increase it further. Talking about enhancing distribution, we added 41 branches in quarter 4. Overall, 76% of our branches are in tier 3 and 4 locations. Our retail book from tier 3 and 4 markets have grown nearly 3x in the last 2 years. As we further expand to 320 plus locations this year, we will enhance direct sourcing in the retail business. We will also continue to build a digital ecosystem to augment our sourcing capacity. From a technology perspective, our agile plug-and-play API tech stack allows us to integrate seamlessly with a diverse set of ecosystem partners and drive digital sourcing at scale. With consistent investment in technology across the lending value chain, 96% of our customer acquisition and 98% of our EMI collection is now through digital platforms. All these capabilities have enhanced exponential volume growth. While these initiatives will continue to be significant growth drivers for the retail segment, we have started implementation of our SME strategy like I had described last quarter. And let me give you a quick update on it. On driving focus in SME industry micro-market clusters underserved by banks, we are already live in 30 cluster locations and target to grow to 120 by the end of this year. We have also gone live with our digital MSME platform in quarter 4, enabling simplified processes and better turnaround times. We hence expect our strategy to yield the desired growth in the SME portfolio over the next 12 to 18 months. The growth of our loan book has been accompanied by strong credit appraisal and risk management practices, which has helped us deliver stable risk-adjusted returns, improve the quality of our book, and deliver strong collection efficiency of 99.6% at a higher than pre-COVID levels. Our strong balance sheet growth, supported by adequate liquidity, low cost of borrowing, investment in technology, and efficient processes, along with bespoke product offerings, provide us the right to win in our chosen segments. To sum up, on the NBFC front, we are very well positioned to deliver stronger growth momentum in FY23, as I mentioned before, targeting 20% plus overall book growth with 65% plus retail and SME mix. With our current growth trajectory and continued focus on key segments and leveraging our technology platform, doubling the distribution of the branch footprint to 320 plus branches, we are confident we will achieve the guided metrics for 24, which we had provided ahead of time. Now I will move to the housing finance business. Coming to the HFC business, we have seen strong growth momentum in Q4 in our chosen segment. It's very similar to our NBFC business. In this business, we have earlier stated that we are growing our affordable mix as we expect that to drive superior returns. Q4 disbursements were up 20% over last quarter and by 16% over Q4 last year. Of this, the affordable segment disbursement mix was at 47%. This has taken the affordable mix to 38% from 27% last year. The shift in the segment mix, supported by lower cost of borrowing, has helped the organization report the highest ever margin of 4.52%, an increase of 89 basis points over last year. Not only have our margins expanded, but our customer selection and calibrated underwriting strategy has helped risk-adjusted returns, defined as NIM minus less credit cost, expanded by 127 basis points over the previous year. With improvement in margin and reduction in cost-income ratio, housing finance PAT for FY22 was up 44% year-on-year, taking our ROA to 1.7% and ROE to 13%. Efficient collection efficiency was seen in this business also at 98.8%, has led to a lower credit cost of 65 basis points. Previous year, this was at 0.73 basis points. We also have a very comfortable A&M asset liability management, and our capital adequacy is at a very comfortable level of 24%. Growing our affordable book continues to be our focus, and to drive affordable penetration further, we have expanded our branch count to 120, with 68% of these branches are in tier 3 and 4 cities, which is our focus market. We have also augmented our frontline capacity to drive affordable volumes and create additional distribution capacity. Direct sourcing is already at a very healthy 73% in Q4, and this we want to really take it up to 80%. This ensures higher customer stickiness, and we want to really take it to 80% by end of this year. Our progress in digital capability gives us confidence of scaling up ecosystem partnerships and co-lending as an alternate sourcing channel. On the technology front, we have made some good progress. Overall, 85% of our files are sourced digitally, and over 98% of collections are through digital means. We have also enabled multi-channel servicing, including WhatsApp, e-bots, Google Assistant, and self-serve portals, leading to 77% of our customer interactions coming from digital channels. With this, I would like to sum up the housing finance business. The structured shift in our business mix, wider geographical footprint, and increased distribution capacity, we expect to see 20% growth in portfolio and steady margins as we keep changing the product mix. We are already at a margin and ROA we had targeted for FY24, and our focus is on growth as the operating leverage will only improve these metrics further. So completely poised to meet the guidance which we had provided for FY24 ahead by a year. Now I will pass it on to Bala for asset management business.
Right. Thanks, Rakesh, and good evening to everyone. As we presented in our AMC analyst call about a few weeks back, and I'll just repeat some other and give a quick update on the AMC business so far, the growth. The mutual fund AEM grew by about 10%, backed by very strong, consistent investment performance. Our equity assets on a year-on-year basis grew by 25%, and overall mix in the assets under management of equity improved to 41% from 36%. And fixed income, we have seen a marginal growth of about 1% to about 1.75 lakh crores. And overall leadership position in the asset management industry, we continue to maintain with about 10% year-on-year growth in the overall asset management. With respect to building our strong retail franchise, in fact, in the years 2021-22, we added about 12 lakh folios to take the overall folios about 7.9 million customer folios. Our individual assets under management grew by about 9% to about 1 lakh 30,000 crores, which is again contribution of the overall assets under management to 48% in the overall asset mix coming from individual contributions. And B30 AEM, we continue to see steady momentum, which again grew by about 5%. It maintained about 16% coming from the B30 market. The another area where we have made a significant progress is on the SIP's registration. We have seen on a quarter-on-quarter basis, a month-on-month basis, the per month SIP's subscription keeps improving. In fact, the Q4 of the last year, it grew by about 46% to 3.24 lakh registration that we had, with again growth about 46% compared to the previous year. As a result of this, our monthly SIP book contribution has now improved about 895 crores, just short about 5 crores to 900 crores. That we can building on the base of building the sustainable business for building our retail. With respect to financial performance, clearly this year is one of the best years from a for profitability point of view. We registered highest ever profit ever in the lifetime of Aditya Birla AMC in FY22, and total dividend, as we had indicated during our roadshows, 50% of our part has been distributed in the form of dividend. In fact, the total dividend distributed for the full year is about 11.45 per share, and interim dividend of 5.6, and the balance of 5.85 we give the current quarter. And FY22 revenue grew by about 17% to about 1,409 crores, and PAT improved by 28% to 673 crores, which again, as I mentioned, is the highest ever PAT reported in the AMC business. In terms of distribution network, while of course continue to maintain our momentum in dealing with all the key channel partners like IFAs, MFDs, banks, national distributors. In fact, we have made some kind of progress with respect to our organized channel contribution, especially the banking channels contribution. The last year we saw an incremental growth coming from the banking channel, which again nothing but reflection of the product being part of the recommendation list of the bank, and therefore on the basis of the investment performance, and therefore the sales are getting pushed. That's something I just wanted to highlight. While doing that, MFDs continue to be a dominant component of about 14% of our asset management coming from MFDs. Again, continues to remain very, very strong and healthy. Then the fifth area where we are high focus in building our alternate business. In fact, since the time we set up a separate team of people, our focus on passive assets as well as AIF assets continue to gain strength. In fact, our passive assets touched almost 9,000 crores as of March 2022, with again 6 times growth compared to the assets under management what we had last year. While doing that, while we had many fund launches we have done in the case of ETF, we also have a pipeline of 15 product pipelines in the current financial year to do more launch of such kind of funds will also be undertaken in building our passive business. And we also closed our first Aditya Birla Sun Life, the real estate fund, credit opportunities fund, with a collection close to about 180 crores as the first tranche. And something again we have done it after almost 10-year gap. Probably we'll see the actually gaining momentum as we move forward. While I spoke about ETF in terms of the size, we also added close to about 320,000 customers in the ETF space, which again fell on the back of our ETF products that are now being part of the recommendation list and also being made available on technology platform for customers to buy. While doing that, we also cited an opportunity building the passive debt ETF during the same period, taking advantage of the rise in interest rates, and therefore that differential product offering also helped us in building our alternate business. Lastly, of course, I just like to highlight in terms of digital, though the update what we had given, there is no significant change in the update what we gave on the digital platform. But I can only say that the digital platform, we have seen incremental adoption to the digital platform, and therefore the incremental volume coming to the digital platform. While doing that, the digital partners with whom we have a tie-up, we continue to expand the list. There are more and more platforms that are coming in, either from a RIA or any other transaction platform. We continue to step up our engagement in order to ensure our products are being part of the recommendation list, and therefore it now comes as a part of the overall content coming from these platforms. This is a quick update I want to give you on the AMC business. I'll now hand it over to Kamalesh Rao, the MD and CEO of Aditya Birla Insurance.
Thank you, Bala, and I'll give you a snapshot of the life insurance business. All the numbers I'm referring to are on slide number 57. So for ABSLI in Q4 at 11% was better than the industry, and this is the second year consecutively that we have grown at 14% in the individual life insurance business. In the group business, this growth is more than double the industry growth for Q4, and year 2 we have grown at 30% plus for 2 consecutive years. What is heartening is that a large part of this growth has come on the back of higher productivity and now at net VNB margins of 15%. We are now demonstrating superior performance across relevant industry peers, also in areas of persistency across the various buckets, growth in absolute embedded value, as well as OPEX to premium ratios in the last 2 years. Our renewal premiums grew at 24% for the year, and we ended at a total premium of 12,140 crores. Both these numbers of renewal premium as well as total premium have grown at a CAGR of 20% plus for the last 2 years. Our enhanced digital capabilities allow us to collect 85% of this renewal premium collected digitally in terms of NOPs. Our renewal bot that we spoke about a few quarters back that we call Zara collected 440 crores of renewal premium this year. At the rate at which we are growing, our bot alone will give us the capability of collecting close to 1,000 crores. Our balanced product mix has consistently helped us take our net VNB margins up. We ended the year at 15% net VNB margins, which is 1 year ahead of our last guidance. At this rate, we have tripled our net margins in absolute value in the last 2 years, reaching an absolute number of 369 crores this year. The performance on net VNB is an outcome of managing gross margins and expenses very efficiently, and we expect our margins to be in excess of 17% for next year. While that's the story of business numbers and margins, the quality parameters have also consistently done well for us across persistency in various buckets, with 13th month now at 85% and OPEX to premium ratios at 12.7%. Both these numbers on persistency and OPEX to premium are again 1 year ahead of our guidance given earlier. The firm now manages an overall AUM of 60,000 crores, and we have had a credible year on our investment management, doing better than the benchmark as well as our peers, and we are in the top 2 quartile on performance for majority of our funds. Our average age of our customers being younger in the 36 to 37 years range has helped us immensely in our upsell initiative this year, with PASA contributing 22% of our new business, and high digital adoption has led to better customer experience, with DIY servicing now at 83% levels. COVID claims, which are in line with our market share of business, was at 257 crores, and in spite of taking this hit, we have managed to grow our PBT by 16% this year, which has made us fare better than a lot of relevant industry peers during the COVID times. With absolute EV growth of 1.5 times over the last 2 years, our EV now stands at 7,609 crores, which is a growth of 18% over last year, with strong ROEVs at 15.4% for the year. Our key guidance for next year revolves around growth in business at 20%, fueled by productivity-led growth in our proprietary channels, as well as garnering larger mind share in our partnership channels for individual business and growing value-accretive segments in the group insurance business. This growth will come at higher net VNB margins at 17% plus. This trajectory will help us double net VNB margins in next 3 years, and in terms of absolute value, getting us closer to the 750 crores mark. So overall, it has been 2 years of consistent growth of business for us, with all our quality parameters doing well, resulting in good net margins for us. With the investments that we have made in the last year, we are confident of the 20% growth plan for next year, with better net margins and consistent ROEVs. With this, I'll hand over to Mayank for update on the health insurance.
Thank you, Kamlesh, and happy to share the performance of our health insurance business. We had another successful year, which ended the year at a premium of 1727 crores, growing at 33% year-on-year ahead of the industry. We actually also had a milestone of completing our 5 years of operation, and we have consistently grown ahead of industry, with the last 3 years our growth being at 51%, at 3 times the average industry growth rate of 17%. Our retail, including rural creditor business, constitutes about 76% of our overall franchise and grew at 23%. But what was also encouraging was a very profitable growth in our group business, which is typically more price sensitive in the industry, aided by our wellness-driven differentiation in the market. Today we cover about 19 million lives, which grew 40% over last year. But I think the key milestone for us last year was, as we have been guiding for the last few years, our first quarterly break-even in Q4 of FY22 stands COVID claims. From whatever information we have, fastest break-even amongst all SAHI players from inception. We ended the year at 109% combined ratio, clearly showing a consistent reduction towards break-even. All of this has been enabled by a very unique data-driven health-first business model, which we feel is the first of its kind in India. And with this model, we not only cater to the existing population, but also add the highly under-penetrating younger and healthier consumer pool, which actually gives us more years of relationship with this pool as we get them into insurance. As we gather more and more health data, we continue to engage with consumers around this whole hyper-personalized health scheme. And we launched our IP around a health risk score called Wellbeing Score. We now cover close to 1 million of our retail lives through this, giving us a clear ability to engage much more deeply with our consumers than the traditional model. We continue to launch newer set of products in the market, and our relaunched flagship product, Active Health, which offers first of its kind 100% premium back, which is, I think, unique globally, not just in India, has constituted about 39% of our fresh premium last year. All of this also has helped us getting much better business outcomes, with our average age of consumers being 5 years lower than industry, 4% lower claims and 25% higher persistency for our highly engaged customers, which we will continue to add based on our differentiated model. We have ensured that we take this proposition fast to the market through a very highly scaled and diversified distribution model, with the traditional agency model constituting around 25% of our business. But the bank assurance model, which actually not just gives us an inorganic capability to reach out to the large mass of Indian consumers, but is also something where we can continue to grow aggressively because of the large capacity there. We now are present in across 4,700 plus cities through our 16,000 partner branches, but also through 56 rural and MFI partners. Last year, we leveraged one ABC branch concept very well, adding newer locations and also new agents in those locations. One of the pleasing outcome of last year was that we grew our digital franchise very, very fast, growing at 89% year on year, and the mix of our digital business is now in 11% versus 7% in the previous year. Because of our model is highly engaging, we have invested in digital and data capabilities from the very beginning, and we work with some of the best and digital partners across the entire life cycle of traditional health insurance model, but also around the theme of health and wellness ecosystem, which helps us create much better access for health and wellness for our consumers, and also gather both structured and unstructured health data, which is then leveraged for detailed analytics to be able to engage with customers at a hyper-personalized level, as I mentioned earlier. Looking ahead, given the fact that we have demonstrated a superior economic model which we follow, we are now looking at next year at a 40% growth in our gross written premium, which will be driven by both capacity addition and productivity enhancements in our existing capacity. We look at doubling our agency, leveraging the one ABC branch, concept, which actually gives us a low-cost agency expansion, unlike when we do on a standalone basis. Similarly, we now work with 12 banks, but we will continue to grow the banker franchise and also deepen our relationship there, but also expand our digital footprint given the strength that we have shown both in product and journeys. And lastly, we'll continue to add new set of customers into the risk pool of insurance, which will be a clear growth lever for years ahead. With that, I now pass it back to Ajay for the concluding comments.
Yeah, thank you, Mayank. In conclusion, let me just reiterate that ABC has built material scale, be it in terms of AUM, in terms of lending book, in terms of its insurance premium, number of customers, and of course in terms of profits. We are today amongst the top 100 listed companies in India in terms of profitability. Our unique model and our strong focus on the value drivers in each business has led to the delivery of key metrics well ahead of our FY24 guidance. Over a challenging 3-year period, we have outperformed peers, tripled our profits over the last 5 years, and doubled our profits over the last 2. The strength of the platform and the huge opportunity in financial services gives us confidence that the business is poised to continue to grow strongly into the future. With that, we'll be happy to open up the session for any questions that you might have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question at this time, they may please press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Naishi Shah from Aqua General Insurance. Please go ahead. Naishi Shah, your line is unmuted. Please go ahead with the question.
Sorry, I was on mute. Yeah, so congratulations on a great set of numbers. I see you all have grown phenomenally across all the big business segments. So I just wanted to know regarding the new RBI regulation regarding, the issuance of credit cards. Now that NBFCs don't need to tie up with banks for credit cards, do you think that's a segment we will be exploring?
I'll get Rakesh to answer that question.
So we have got the in-principle approval from RBI for co-branding with a large issuer, the largest issuer, and we are going live in Q1. We are also parallelly looking at taking a RBI approval for having a license to issue credit cards for ABSL as well. Yeah, so we would look at that.
Okay. And any plans for borrowing in the market anytime soon? And with the expectations of like the rate hike in June itself?
So borrowing, we have enough from a liabilities point of view, funding point of view. We have enough funding available. Capital adequacy is quite comfortable at around 22%. For both our businesses, 22% and 24% for housing, so we don't need a capital raise or funding. And in terms of increase in pricing or the cost of funds going up, the rate hike which you mentioned, we have majority of our portfolio is floating rate loans, and we have the ability to pass it on to our customers if the cost of funds goes up. And we have demonstrated that over a period of time.
Correct. So just the last question. So what would be the proportion of floating rate loans, if you could give us a breakup?
So we have a very well-matched asset ALM. We have 35% of our liabilities is fixed and 65 is floating. On the asset side, we have 34% of our assets are fixed and 66% of our assets is floating. So it's very well matched. Also, majority of the fixed rate loans are on the retail side where we have 2 years, 3 years, the term loans, the personal loans or a business loans which we give it to them, which is at a much higher yield. So we don't have any rate risk which we see. If it goes up, we will be able to pass it on.
All right, sir. Thank you so much. That's all.
Thank you.
Thank you. The next question is from the line of Pankaj Upadhyay from State Bank of India. Please go ahead.
Hello. Good evening, sir. And congratulations to the whole team for putting up a stellar performance. I have two questions. What is the breakup of restructured loan book in both NBFC and HFC? From which segment the contribution is more, like from retail, SME, or certain light on that? And my second question is, how many partnerships both NBFC and HFC have entered as a co-lending model?
So, what was the first question? Restructure. So 70% of our restructured portfolio in NBFC is retail, and close to around 25% is SME. That's in terms of the mix of the restructured portfolio. And co-lending, we have partnerships. We have close to 16 odd partnerships where we do. We have different models in terms of arrangements with these partners. So whether we participate or we co-lend, but yes, we have 16 odd partnerships, which is there at this point in time.
Thank you, sir.
Thanks.
Thank you. The next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir, and congratulations for a great set of performance for Q4 and FY22. So on the AMC business, how should we think about PBT to AUM or core PAT to AUM ratio over next 3 to 4 years, given that competitive intensity in the segment has gone up quite significantly, where we hear that incremental equity AUM is coming at just 20 basis points of net yield. So how should we think about core PBT to AUM over next 2 to 3 years?
Parag, you're taking the call? Preparing the question? Yeah.
Sure. So, overall, looking at the PBT of the asset management business, it is a mix of the overall mix of assets which will be equity, high margin debt, and the alternate asset which we are trying to build. So over the period, we are trying to maintain or improve our overall revenue to the AUM, bids to AUM, and that should flow in the bottom line also, because our focus will be on rationalizing costs and bits of cost to the overall AUM to maintain at current level or reduce it further.
Sure. So what is the driver of revenue bits improving?
So it will be the overall growth in the overall asset which we manage, plus the growth of equity and high margin debt in the overall mix of domestic asset, plus the alternate asset which we have created a very focused approach will start contributing higher to the overall mix.
Sure. Secondly, in the life insurance business, if you can share what is the impact because of mortality in the EV walk for FY22.
Like I said, the incremental impact that has come this year is obviously on account of claims, and we put that number on record to say it's 257 crores of COVID claims that we paid. Non-COVID claims were by and large on plan. And as we see through the year, if I see Q4 of last year, we are back to the normalcy level. So, I mean, that impact we've been able to take, but like you said, in spite of taking that hit, we've been able to show PBT growth higher as compared to last year.
Yeah, because still after taking such high impact of COVID, we have reported positive operating variance. So if you can give a breakup of what has driven that positive operating variance, that would be helpful.
No. So if you're asking mortality assumptions, if we brought about a change, like I said, between normal and COVID, if the exception was only on account of COVID and normal not having any impact, there are no change on long-term mortality assumptions into any of the products.
Sure. Because I believe that there will be negative impact on the EV walk in the operating variance. There would be some negative mortality impact. But despite that, we have reported a positive 17 crore of operating variance. So there must be something very positive for either on persistency or expenses. So I just wanted to understand if you can give the breakup of the 17 crore of operating variance.
If you see there is a bridge which starts from the opening EV, and for the elements that are considered in the ROEV at 15.4%, there are a lot of positives in terms of OPEX management, a lot of positive in terms of the gross margins that we generated, and if you knock that off against the variance that you got on account of mortality, the large contributors of that 15.4 would be the unwind of the profits, and the net would be the acquisition that we have done. So of the 15.4, the contribution of that would be close to about 15.1, 15.2. And everything else that we've done would be offset against the higher mortality. It's not given us extra incremental delta there, but like I said, on a long-term basis, net of COVID with mortality assumptions not changing, that number will look better over the next few years.
Sure. And last question on the health insurance business. There we have been able to scale bancassurance business really well. I don't see such high contribution coming from bancassurance or any other standalone health insurance company. So what are the key factors which has driven that, and how do we control the renewability of these business which is coming from bancassurance?
Yes, Sandesh, I think one of the reasons we've got good success in bancassurance is our product profile, and also the match that it has with the customer segment of the banks. Typically, like banks like HDFC, Axis Bank, they have younger salaried customer profile, and for them, our kind of products which appeals to the younger and the healthier consumer segment has given us a big headway, because it actually opened up a newer segment of customers for these banks. Of course, our brand strength always helped us. And we took that first mover advantage when in 2016, when other insurers were not necessarily looking at banks and focusing on agency, we felt that it could give us an inorganic growth opportunity. And over a period of time, we have just strengthened our capabilities there over our competitors. As regards as renewability, my sense is that there's no reason why in the medium to long term banks will have any lower renewability than any other channel. It's just that banks are kind of in a way maturing in the health insurance category, just like they took a few years in the life insurance side, and you guys very well know that in life insurance their persistency is much higher than agency. And I think as their processes, the way they'll work along with manufacturers, start maturing, I think we'll start getting closer and closer to the agency. And we're already seeing that trend in the last 18 months.
Sure. And then this health insurance business that we are getting from banca, is it structured as a retail business or structured as a group policy for the bank customer?
We virtually do, virtually everything is retail. There's a small segment of what I call voluntary, retail on the group platform, but we hardly do the corporate or group business. There's hardly not even 1% in the banca franchise.
Sure. That's it from my side. Thank you.
Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. Next question is from the line of Bhavik Dave from Nippon India MF. Please go ahead.
Yeah, hi. Am I audible?
Yes, you are.
Yes, you are audible.
Hello?
Please go ahead.
Yeah. Sir, thank you for the opportunity. Sir, a couple of questions. One is on the retail side of the business, which you are scaling up well. Just wanted to understand the partnerships that we have with fintechs, right? So we've mentioned that 15% of the portfolio is currently there. So I'm assuming 15% of 17,600 crores odd is the one which is via these digital partnerships, right? Is that a fair assumption?
Yeah, that's true.
Okay. And also, if you could just help us understand what is the kind of throughput that we are seeing with these digital partners, like in the sense you mentioned that 37% of disbursements for the year has been via these partnerships. If you could just spell out the number for fourth quarter and how is like the monthly run rate been on these platforms for us on the disbursement basis?
So we have built a very unique digital distribution capability which we integrate with the partners, and we have built an in-depth ecosystem across education, healthcare, e-commerce, payments, merchants. So that's how we are looking at across the industry segments. And in terms of throughput, we have close to 500,000 customers which gets onboarded through these ecosystems.
Okay, and what would be the disbursement amount in the fourth quarter? Because you mentioned 37% for the year.
So disbursement in fourth quarter, you have the disbursement. So 37% of our retail business is coming through the digital ecosystem. Okay. In terms of disbursement, and that is 15% of the overall retail portfolio.
15% of the overall, because I think 9,800 odd crores is our disbursement for the quarter. 65% is retail plus SME. How much would be retail and SME separately if you could just spell out?
So retail is close to 4,000 crore and SME is 1,650. Yeah. So
okay.
Yeah.
So 15% of that 4,000 crore is roughly, 37% of that 4,000 crore is roughly the digital partnership-led disbursement, right?
Yes. Yes.
Okay, well understood. And sir, you mentioned that you've like almost already got like 4.1 million customers via these digital partners and ecosystems, and we intend to do cross-sells of personal loans to these customers or BNPL. How does the economics work here? Because if the customer has come in via, like suppose a ABC fintech partner, and now the customer is with us because we are lending our balance sheet. So can we cross-sell products to them without paying a fee to the digital partner? Or every time we interact with that customer, we have to pay out that 2-3% payout that we do to our digital partner?
So we have different economics. So we have different arrangements which is there with different partners, and through our own ecosystem also where we acquire customers directly, and we have built a cross-sell and upsell journey. So it's similar to what we do it for our internal customers, we do it with the partners as well, and we have different arrangements with different partners.
Sure.
Yeah.
Sure. So would it be
and also on the economic side, I think I would just like to add, it's more a capex model than a opex model. Once we have built the capability, our digital capability, and we have built our analytics and analytics model and scorecard models, I think post that, I think the cost is very little in terms of onboarding the customer or in fact, even if we have to go and give them a top-up. So very little variable cost which is involved here. It's more a capex model which we have already invested in.
Sure, understood. And lastly, sir, on the affordable housing piece, and then I see that future planning on affordable housing. Just wanted to understand, if we reach 65% of our home loans or housing business into affordable housing, why is the expectation of ROA is only 1.5, 1.6? What we see from the listed affordable housing players today, they generate anywhere between 3 to 4% ROAs when they are like dealing with the subprime or lower end of the spectrum, low ticket size customers. Just want to understand how different is our strategy versus them, because the ROA expectations are fairly like is half of what you guys are. Sorry?
Expectation, that was a target we had set for FY24. So obviously, since we're already ahead of that, as we go ahead with this affordable strategy, there should be upside to that number. We've not revised that number, but that was our target we set earlier.
Understood. Okay. All right. Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and one. The next question is from the line of Ashwin Balasubramanian from HSBC Asset Management. Please go ahead.
Yeah, hi. Just wanted to understand on the housing finance book, the restructured portion under moratorium you've mentioned is 3.4%. So earlier, if I'm not wrong, the overall restructured book used to be about 7.5%. So just wanted to understand the rest of the book. Has it come out of moratorium, and when will this remainder come out of moratorium, and what's been the performance of the book which has already come out of the moratorium?
So 4.6% of the restructured book has already come out of the moratorium, and they have started paying their EMIs. So that's the reason why you see 3.4% is still under moratorium.
Right, and out of that 4.6, how much would have sort of slipped?
So I'll tell you, in terms of collection efficiency on this portfolio is also pretty high. In terms of slippages, I think I can share that details with you, but it's not nothing.
Stage 2 and Stage 3 have come down. Stage 2 and Stage 3 have come down in spite of the.
So even if you see after opening up of these reached to 4.6%, the restructured portfolio which has opened up, our Stage 3 and Stage 2 both has come down. So that's a clear indication in terms of what is flowing forward and getting resolved.
Right, right. And the similar number for the NBFC, so there the restructured book used to be about 4% and that's come to 3%. So the rest of the book is, this 3% is still under moratorium, or does this also include a portion which has come out of the moratorium?
So 67% of the 3% has already started paying their EMI, and so that has opened up. So it should be very similar to what we have on the, and I can give you, it will be around 1.2%, which will be left 1%.
Okay, okay. And in the housing finance book, the prime home loans, I mean, if I look at it, let's say year on year also has come down even in absolute terms. So, I mean, is this more like a conscious strategy, or I mean, is it because of higher BPs out in the segment? And related question would be, what would be the yields across the various segments, in terms of affordable and prime home loan and LAP and affordable LAP?
So for your first question, it's in line with our strategy to focus on the affordable segment. And in the prime segment, we are primarily focused on loan against property and all. So that's the strategy. In terms of yield in different, I have it. I can share that with you separately. Yeah.
Okay. 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 Yeah, that's it from my side. Thank you.
Thank you. A reminder to our participants, please press star and one if you wish to ask a question. The next question is from the line of Aditya Birla from Motilal Oswal. Please go ahead.
Yes, thank you for taking the question. So just one question here. I mean, you talked about digital partnerships and the digital ecosystem, what probably the fintech ecosystem. You've already shared, I mean, what disbursement numbers were in the fourth quarter. Just trying to understand, I mean, these different ecosystems that you talked about, education, healthcare, travel. Can you give us an idea around what are the typical ticket sizes? What I'm trying to understand here is, I mean, while everyone is talking about disbursing through ecosystem or fintech partners, how have you worked around the collections aspect, especially given the fact that these are all predominantly unsecured, low ticket size loans?
If you look at, there are different products which are there, especially if you look at a product like BNPL, where the ticket size is fairly small. It's a short-term loan. And the idea is once you acquire the customer and you have the track record of the customer, we can go and cross-sell a higher ticket size and longer tenor loan to these customers. And that's the journey, and that's what we have mentioned in our investor deck also, that we have started selling personal loans to these customers who have been acquired over the last 5-6 months. So that's on the BNPL side. In terms of education, the ticket size can be 60,000-70,000 rupees. On MSME, it will be upwards of 1 lakh. So for different products, the different ticket sizes are there.
So then how are these collection mechanisms set up? How is collection being done in case of a default?
So with different partnerships has different arrangements. In certain case, the partners manage the collection. In certain, we manage the collections, and we have a infrastructure and we offer this wherever we have the collections infrastructure. With certain partners, wherever we have the collections infrastructure, we only operate and we provide loans there. So we have our own collections infrastructure, which we really because we also have a large retail franchise and a large retail collections as well.
Thank you, sir. And maybe just one last question here. In case there is a default, you are suggesting that either the partner or you are involved in collection. Still early days, but how is collection kind of panning out? Particularly in these product segments, because when we engage with a lot of, I would say fintechs who are in, let's say, consumer loans, education, healthcare, most of them seem to suggest that they have still not, worked out collection mechanisms as yet.
So these are not early days. We have been doing it for the last almost 3-4 years. In terms of we built the digital lending capability and the platform almost in FY16-17, and we have experience from those days. So and also we track the performance and the flow rates of each partner or each customer, and we look at what we need to do in terms of the collection. And so far the performance on the pool is pretty decent. It's sub 2% is the credit cost on this portfolio.
Great, sir. Thank you so much. And if I can squeeze in just one last question here. When I look at your bank term loans, large part of it would be linked to MCLR or some kind of an external benchmark rate or repo.
You're talking on the liability side?
Yeah. Yes.
Yeah, so I think it will be, and if it's ECB or something, it's fully hedged. And so, as I mentioned earlier, we have close to around 35% of our liabilities, which is fixed in nature, and 34% of our assets, which is fixed in nature.
Sure, sir. Thank you so much, and wish you and your team the very best.
Thank you.
Thank you.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference back to Ms. Ajay Srinivasan, Chief Executive, Aditya Birla Capital, for closing comments.
Thank you very much. Thank you everyone, ladies and gentlemen, for joining this call. Wish you a lovely weekend and a week ahead. Thank you.
Thank you very much. In case of any follow-up or further details, you can reach out to Mr. Pramod Bora, Investor Relations. Ladies and gentlemen, on behalf of Aditya Birla Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect. Thank you.